This is Sovereign Debt, a podcast on greening the global economy and debt sustainability. I'm your host, Jill Doshi. Welcome back, everyone. It has been a very long time, I'm aware. Some of you have been asking for new episodes, and some of you have been questioning whether I've given up completely on the podcast. And at least one of you accosted me at the annual meetings in Marrakesh and said, "Where's the podcast?" So here I am. I'm going to try to come back a little bit more regularly going forward in 2024. And all I can say is it's been very busy for everyone. And we're kicking off the new year with some friends and colleagues who have also been extraordinarily busy over the last few months. Well, actually, even longer, and I'll let you guys get into that. But we're super excited to have them here today to talk about a growing issue of importance in the international markets, and that's about currency risk. So I'm very glad today to introduce from TCX, Ruurd Brouwer and Harald Hirschhofer from TCX. And we've been trying to schedule this for months, but like I said, we've all been extraordinarily busy. So thank you so much for taking the time to be with us today.
Thank you very much for having us, Jill, and for kicking off the new year with Harold and me. Yeah, thanks, Jill.
Wonderful. So to begin, I wanted to give the audience a little background first about TCX. You were founded, as I understand, in 2007 and continue to be supported by several development finance institutions, microfinance vehicles, as well as the Dutch, German, French, Swiss, and British governments, as well as the European Commission, I believe. What issue was TCX aiming to address that was not already being handled by these institutions and kind of the architecture, if you like, in general? What was the gap in the architecture?
Well, that's actually pretty straightforward. So most of our shareholders, but actually pretty much all of the development finance players, they have a hard currency balance sheet, dollars, pounds, euros, yen, whatsoever. And most of their clients are actually earning local currency. Now, the bad habit has always been to offload the currency risk to the borrower. Well, ultimately, since most of these borrowers are local currency earners, and that goes for microfinance institutions, but also SMBs, the infrastructure sector, even the sovereign borrowers, it creates instability, it creates unpredictability of debt service, and it actually achieves the opposite of where the development finance industry has been set up for. It's been set up to create green economic growth. And for that, you need stability. And offloading the currency risk, well, it creates instability and unmanageable volatility.
So you basically saw that, okay, well, we have this currency risk problem. We have these institutions that are, denominated in hard currency. You're not one of those institutions. You're kind of funded by some of the kind of governments behind them. What is TCX?
It started actually at FMO. And at the time, they were managing an SME fund, and that was funded by the Dutch government. And the unique thing about it, it only lent in local currency using local interest rates. And after about 10 years, they decided to do an evaluation, and with the goal to see how much money had been lost actually because of all these terrible depreciations. And that evaluation actually showed not only that there was no money lost, but because they used local interest rates, there was a positive return of like 0.3, 0.4%. So it was close to zero, but no money was lost. And then actually based on that evaluation, FMO thought, well, this might actually be the solution of a global problem. Mm-hmm. We then started working with a firm here in Netherlands, Cardano Risk Management, and we asked them to do a 10 and 20-year backward-looking analysis. What if I would have had a portfolio in 10, 20, or 40 different frontier markets? And that actually backward-looking analysis also showed, well, if your diversification is good, if you use local interest rates, there is a marginal positive return to be made. whilst actually resolving this global problem of currency risk for borrowers in emerging and frontier markets.
Now, if I may perhaps also add here a little bit from our business model, right? I mean, one of the benefits is, of course, that we have very significant economies of scale. And I think by joining forces among various DFIs and MDBs, you can benefit from these economies of scale. So one economy of scale is obvious from the diversification aspect. You have many of our shareholders have very regional portfolios because they focus on a specific part in the world and they don't have a global portfolio. They cannot replicate diversification internally. Others are relatively small and they also would not, because of the size, achieve efficient diversification. So by pooling currency risks, these various DFIs optimize their diversification potential. So that is one thing. Second thing are obviously operational economies of scale, from expertise of assessing, quantifying macro risks, pricing that correctly. That is another expertise. Another economies of scale comes from our ability to bundle various transactions in the same currency together and then resell that risk to other investors. So our balance sheet has a function of converting, tenors, converting sizes, and that facilitates, of course, quite a lot of how to deal with currency risk.
So you have the kind of backing of the international community. You've identified that there's this risk that this development finance is often in hard currency, which is not necessarily the best for the borrowing nations. You could have confirmed the analysis that it's not a terrible risk for donors to be kind of getting in local currency, if I'm understanding you correctly. So then the donors say, okay, well, let's come up with a fund. What exactly is that fund doing? So that you're providing hedging instruments for the borrowing nations, or is it you're coming into the actual lending institutions, or is it just somewhere sitting in the middle?
So actually, we're pretty simple. People tend to think that currency risk is complicated, but so we use swaps and forwards based on normal standardized international documentation. So we have these agreements with all of our shareholders, but many more parties than that, also 20 to 30 commercial banks. And most often the borrower, so let's say the borrower in Ghana, that suddenly gets offered a loan in Ghanaian cedi, they don't even know that we're behind it. So it's a development bank that offers the loan in local currency.
Okay.
But through their back door, they have an agreement with us where they offload the currency risk. So for the lender, at the end of the day, nothing changes. The same amount of dollars go out and come in. The only difference is that through the agreement we have with them at the back door, if the cedi depreciates heavily, their exposure goes away from the borrower in Ghana and it moves to TCX here in Amsterdam.
Okay. Just going to currency risk in general. I think it's generally termed kind of the original sin of the countries are borrowing in currencies that are not their own, and that this causes an enormous amount of risk going forward. Can you just, for the audience, just kind of unpack that a little bit? Like, why do governments borrow in other currencies? What are the constraints that are forcing them to do that? Or are they choosing to do that for other reasons?
In principle, most often have no alternative. So, and that's indeed the original sin. These are countries that have a need for long-term funding that is not available in their local markets, in their local currency, either not the size or not the tenor.
And what is that lack of local financing really coming from? Is that just there's just no money in the countries, or there's no long-term borrowers, or what does that mean that we can't borrow in our country in our own currency?
Well, the starting point is the lack of local savings. And that's actually why the entire world of development finance exists, all the multilaterals and the bilaterals. There is a lack of local savings to productively invest in the local economy, creating local jobs, etc., etc. So for that reason, savings from abroad go into these countries to allow them to invest in productive capacity. So that is the key reason. These are poor countries, lack of savings. So savings have to come from abroad, from the rich countries.
That's another way of saying that there's not, pension funds set up in the countries. There's not insurance companies in the countries. There's not these pools of capital that have been institutionalized in one way or another, right? That can be
exactly
purchasing debt.
Also, a lack of trust in the financial system sometimes, right? And then you don't have enough savings going into the official banking system.
Right. Okay. So this is like kind of just again to kind of help everyone understand and kind of connect the dots. This is where, as you say, development finance is really coming in because there's we're helping countries develop those markets, develop those institutions, develop their economy so that they can kind of accumulate that capital in the country.
From that perspective, having a fully functioning local capital market that uses local savings from pension funds or institutions, like you say, that can actually finance the local government and local infrastructure needs, that solution is actually a lot better than what we are offering.
Right.
The harsh reality is it just doesn't work that way. And many of the multilaterals focus on developing local capital markets. But what we see in practice, that is a 10, 20, 30-year investment in time. And many of these local markets, because of the sheer smallness of the size of their economy, will just never be able to generate the local currency financing that is needed for the market.
But even if, say, we agree to build domestic institutions and build the trust of the population in their pension system, in their banks, and I'm sure we will get there sooner or later. But even then, you want to say, should I invest as a pension fund manager most of my savings domestically, particularly if I have a very small economy? Should I expose my pensioners also to the national economy so much? And as soon as you will see these pension funds invest abroad, you again have the currency risk issue. So that's why we are arguing very much, we need to build on these risk markets and create risk markets which separate credit risk and allow for an efficient credit diversification from the currency risk, and then allocate the currency risk in a different way because you have different appetites. So that's why, an institution like TCX, which supports the creation of currency risk markets, is very useful, even if you have a good growth in pension funds and domestic markets.
Then when I'm thinking about countries that, as you say, kind of a smaller economy, not a lot of domestic savings, not a lot of these institutions, but maybe it's growing, maybe it's starting, the domestic markets is available to some extent. And we've seen that kind of growing in particular, and we'll get to kind of where that ends up leading to problems. But as those markets grow, the sovereign also kind of has a choice then, a kind of growing choice. Do they borrow in the domestic market or do they borrow abroad? What are the kind of thought processes? I've talked to governments and they'll say, well, it's less expensive to go abroad. And you already touched on kind of the idea that you can maybe get longer tenors and it appears cheaper. The interest rates are, potentially lower, or it's more stable, or do you see that as well? Or can you kind of explain that dynamic of that choice of a debt manager, if they have the luxury of choice, but of how they decide between those markets to tap into?
For those markets that indeed have the luxury to choose, there's the local market with, in general, higher interest rates, mainly tied to the fact that the inflation expectations are significantly higher.
Right.
Then many of them have access to either the regional MDB or World Bank IDA. And what we've seen over the last 5 to 10 years, that there temporarily has been an increased access also to the international bond markets. And of course, then there's the players like China, Saudi Arabia has become more active. So other, let's say, official bilateral flows. Yeah, in principle, if that manager has the possibility. It is trying to build a book that from a risk perspective fits as much as possible the inflows of the country. So for an oil exporter, that will be completely different compared to an oil importer.
Right.
And that is only, let's say, the currency part. But then, of course, you have the tenor. You have to compare the different prices. And in general, most of them prefer, of course, the soft funding form. So those that are concessional in the eye of the lender. So the 30-year loan, 10-year grace at whatever, 0.5%.
So some of that concessional finance is only available, again, to your point, in hard currency.
Yeah, and that's why I always call it concessional in the eyes of the lender, because concessional in the eyes of the borrower is something completely different. If Malawi borrows $250 million and a month later they have their 40% depreciation, suddenly their debt goes up in local currency with 40% without having borrowed an additional dime. And that's, of course, a nightmare scenario for any debt management office.
And that's a good point. Then that's even if they've borrowed, quote unquote, on concessional terms, right? Just their own currency position could deteriorate to such an extent that suddenly that concessionality disappears.
Yeah, it's a lender's concessionality. A borrower's concessionality would be if they have the possibility to borrow significantly below their local risk-free rate. So the Malawi Kwacha yield curve, and then 10 percentage points below that. That is real concessionality. The length concessionality is actually a form of speculation that you hope that the depreciation isn't that bad.
Sometimes the concessionality, it's actually a double-edged sword, because it's like a cloud. It's a veil which perhaps hides these risks, right? By having very low dollar interest rates, the borrower feel perhaps overly comfortable in taking these loans. And even if they invest them in areas which don't yield enough return that they can in the future be repaid, because they really do not see the currency risk. We have made a survey together with the IMF about the debt management capacities of certain countries, and I hope this will come out as a IMF working paper soon. Mm-hmm. And during that survey, it became sort of quite clear in that survey that very few debt management offices have this hypothetical capacity to optimize between hard currency and local currency debt allocations, because they don't really have the capacity to quantify currency risks. And they also don't have the capacity to manage them, especially the poorer the countries are, the lower the per capita income is, the more they are dependent on these hard currency inflows and from MDBs in particular and concession lenders. That's sort of like, in a way, the opposite what it should be, because their economies are very undiversified, because they are sometimes very small and they are most exposed to external shocks, be it pandemics, climate risks. And, these are the countries which we would need to protect most, and they are the most exposed to these risks. So I think these optimizations between, should I take hard currency, should I take local currency, this is overdone.
I agree. Certainly the poorer countries, as you say, are kind of almost solely reliant on that, with quotation marks, concessional financing. And then there's other kind of economies that have beginning or, kind of even middle-sized domestic markets that have this luxury of choosing. But let's go back to the poorer countries that rely on this kind of hard currency lending. Just again, to kind of state the obvious, there are no other hedging mechanisms for this. I mean, one, they might not have the kind of knowledge in-house how to do that, but even if they did, prior to TCX, there's no ability really to hedge those currencies, because they're just too small in the whole scheme of things. Is that correct?
Yeah, that's correct. And what is fascinating to see that in the past 75 years, as a result of that, the entire development finance industry has become a dollar industry. So when we sit down a couple of weeks ago with the Minister of Finance of Rwanda, and we explain what the Rwandan franc rate is if they would hedge part of their sovereign debt, they immediately start calculating everything back to the dollar, because that is the way they're used to look at their debt management. And then you try to explain, but seriously, your income is in Rwandan franc. You must look whether you can pay for your debt at Rwandan franc levels, and you should actually ignore the equivalent price in dollars. But it's deeply ingrained in the system, also with debt management offices. And understandably
also, because they're also, when they're talking to rating agencies, when they're talking to the MDBs, everybody, the IMF, they're usually speaking in dollars. Not always, but unless they have, again, this comes back, unless it's a country that has a very significant domestic market, then I think, then it does kind of switch over in everybody's head to kind of think about it.
We always use the example. So we ask emerging market debt management officers, so what do you think that the open FX exposure is for the government of Germany, US, Switzerland, Japan? I mean, that's all 0%, because no government that can prevent an open exposure will ever take it, because it's speculation. Yet the poorest country are forced to take it, whereas they have the least means to actively manage it. They either have no exports, or they have only oil or copper or a single export. So these are the poorest, most vulnerable, least diversified countries, and they are stuck with a risk that is just totally impossible for them to manage or influence. And that is really, if you look at why the development finance community has been set up, why the industry exists, it's almost ridiculous when you get to think of it. So the biggest, least manageable risk we offload to the poorest that have the least means to manage it.
We have been trying to highlight that to various stakeholders. We have developed in one of the things which we are trying to popularize, this idea that, we need to be more aware of the need for currency risk management, debt allocation is, we developed the HERE ratio, right? This is that we relate, what happens if a currency depreciates, how much does that service go up for a sovereign? And we relate that to, in this case, to health and education, primary health and education expenditures. But you can also relate it to tax revenues and other things. And we see that the poorest countries, which often have, hardly any fiscal space left, are really hit hardest if their currency depreciates. And again, I said before that, they are least diversified. So you have the strongest currency depreciation effect potentially. And that really is unacceptable. One should not force these low income countries, because of that we give them difficult debt instruments, to adjust other expenditures strongly just to continue servicing their debt.
I want to, because you mentioned the countries that are kind of dependent on a certain commodity. Does this issue really change if you are an oil producer or you're a copper producer or something, and that you have most of your income of the country is actually dollar denominated? Or does it depend on what kind of country you are? Like if you're a commodity country, is this less of a problem?
When, as a country, you have significant dollar income streams from indeed any type of commodity, then it's of course much less harmful if you have a significant dollar borrowing, because you have dollar income streams in any case. The moment you have limited or almost no income in dollars from exports, then having dollar debt just creates an enormous mismatch in the country's balance sheet.
I think it depends, of course, how the trade balance is and how dependent they are from imports, right? So they may be exporting a lot, but if they have to import also a lot, then it's a different situation than if you're net exporters. So that's the biggest challenge.
So I get the picture of the kind of the pressures that the country is under, that they are borrowing a lot, even as we say, concessionally from in dollars. They don't have control over that currency, et cetera, et cetera. There's not hedging markets available to them. But what TCX is offering is, as you say, kind of slipping in between the lender and the borrower and kind of dealing more really on the lender's side. As a sovereign debt manager in one of these countries that we're talking about, I don't necessarily approach TCX, or can I approach TCX and kind of tell them, go talk to my concessional lender and figure this out for me? Or how is this working? What are the products that you're offering, and how is this kind of being rolled out?
Yeah, so what we see in practice is that more and more debt management offices approach us directly. We just finished a 6-month TA program with the debt management office of Georgia. Jointly preparing them. I mean, they have a very focused and very disciplined dollarization policy. So it's not about de-dollarizing, but it's about more use of the local currency. So they are all set up, ready to go. And now it's more a matter of when the price is right, they can actually trade. That will always continue to be, for every debt management office, crucial part, whether the price is right. And we've done a whole series of, let's say, in-country or regional meetings with debt management offices. And we see there is a big thirst to better understand it, because the vast majority in their medium-term debt strategy, they do have a target to bring down the dollar exposure. But there's, of course, like you already indicated to yourself, Jill, they have very limited tools to actually realize that. And in all transparency, so today we are much too small to make a significant difference on a global scale. But what we as TCX can offer is clear visibility on a model that works and that can actually become a global solution for effective.
So, Jill, your question is super interesting, right? I mean, how would how are we deploying our capacity and let me go back to this study and the survey from the IMF, right? We have found that many debt management offices, debt managers, sovereign debt managers, there is a capacity shortage and we need to build a lot of capacity. So we are engaging indeed in capacity building efforts. We did something with Georgia. We received other requests from several other countries. I would still think that, the most promising in the medium term in the coming year, the most promising way is that first of all, the debt management offices know about that MDBs and the DFI community has this capacity to lend in synthetic local currency or index to the local exchange rate. That is the most promising way to quickly reduce the exposure. So we have been working with the IDA Secretariat. We're in touch with IFAD. We had calls with GCF, particularly the highly concessional lenders, which lend to the low-income countries. The small low-income countries are having a huge responsibility in this field. And, we need to let the debt management offices know that they can approach these lenders and say, please, yes, give us dollar lending, give us the dollars. We need the dollars, but let's index the repayment, the debt service to the exchange rate. So if we are exposed to a climate shock, if we suffer from an earthquake, from a hurricane, if there is a global pandemic and tourism flows stop, then we repay fewer dollars. And, the MDBs then can hedge their exposure with sophisticated players like TCX or the market, if there is a market for that risk. And in that way, we can, on a relatively short time frame, systematically bring down the currency risk exposure of low-income countries. But the MDBs here clearly are asked. They have a huge role there. So, yeah, if a DMO wants to approach TCX, please, that we are open. We are very welcome. We help in any way we can. But I think, to make a systemic change, the MDBs are the channels through which that has to work.
Well, I would say that, first of all, this podcast will hopefully help spread the word, because we're in over 140 countries. So you can speak directly to them on this platform. And then when it sounds like, and I don't want to kind of get ahead of us, but it sounds like that what you're building at TCX is kind of like almost like a pilot program or some sort of proving the concept. I mean, maybe that's not the way you think of it because it was your business. Is the idea that TCX will just continue to grow, or is this kind of your backers are kind of trying to, again, kind of prove a concept so that this actually becomes an integrated part into the architecture? Is the idea that this is all kind of automatically kind of all lending, or is this remains kind of a separate piece of the puzzle?
It definitely is, because let's start with the beginning. Because originally, most of the business TCX did was with microfinance. And actually, we were helped a lot when the client protection principles kicked in that required transparency and predictability of debt, etc. That meant actually that the microfinance industry moved quickly from being dollar-based, like sovereign lending is today, to local currency-based. So in the early years, 80 to 90% of the volume that TCX did was actually for microfinance. It's in the last 2 to 3 years that we see an increasing demand from public sector and sovereign borrowers. So, of course, we've had our fair share of conversations, specifically with the World Bank that has a natural global diversified portfolio. But on their side, they indicate, and that goes for most of or actually all of the regional development banks as well, they say we are not going to go lending in local currency, even if we could build a diversified portfolio.
Okay.
So from that moment on, I stopped talking about TCX's mission or strategy, but more about our destiny, because in the absence of any credible player stepping into this FX risk management market, it's up to us. The ability for us to start doing single tickets of about 500 million to develop support at scale. Second, actually, and that is something that we've been doing now quite consistently over the last years, the risks or the currency risk that we get in our book, the trading team sells to the commercial market. So what's happening, and that is not only, let's say, the 22 years that we have exposure in India for a solar plant, but also for the case of Sierra Leone's. We've done, I think, about 15 to 20 transactions in Sierra Leone. So we saw the exposure rising. Then we turn around to the market. We know parties that are interested in frontier and emerging market currency risk. We say, are you willing to buy 3-year Sierra Leone risk from us at 14%? And that machine that we onboarded, let's say, and we take away the FX risk from SMEs and borrowers in emerging markets, and we sell it to institutional investors and pension funds in the West. That is how I believe ultimately the end game is going to be. In the case of Uzbekistan, we've structured and sold 15 Uzbek som bonds. That's a little bit technical, but we ask one of our AAA rated shareholders like FMO or IFC, please issue a bond in Uzbek som. We hedge them back to dollars. For them, it's normal funding. But the investor gets a unique combination of AAA credit risk with the market risk of Uzbek som. And that makes it an investable asset class for these investors.
Understood.
And we get rid of the risk in Uzbek som. And actually, after having done that for 15 different bonds, what we saw happening is that the market got used to invest in Uzbek som risk. And on the back of that, the Minister of Finance of Uzbekistan for the first time could also issue in the international capital markets in Uzbek som.
Right.
And we believe that route is also over time open for larger emerging markets to actually issue in their own currency in the international capital markets.
Very interesting. I actually want to pick up on like one little minor point in all of that. That was like a super interesting thing, and I would love to see it all marked out. And I just love the fact that would actually lead investors to start thinking about these kind of frontier currencies and markets and kind of flexing that muscle so that suddenly they're willing to go into that. I think that's a fascinating dynamic. But there was one thing you said in all of that that I want to kind of pick out of, because you said you started with the microfinance, but then you said, in the last couple of years, you've seen this uptick of interest. Can we just unpack that a little bit? Why have you seen this uptick in the last couple of years of interest in this currency risk issue suddenly with kind of emerging and frontier markets? The last couple of years have been very interesting for so many reasons, in the sense of, like I said, kind of the unwinding and QE, the kind of rising of inflation expectations, rising rates in advanced economies, the pandemic, the climate risk. What is it that's driving that interest?
I think it's depending on the period. So for last year, we grew 65%. And I strongly believe that, let's say, the combination of first COVID and then the invasion of Ukraine, they both had a very significant impact on the dollar local currency exchange rates. And both instances were completely outside of the control of emerging market borrowers. And they did see almost overnight, what we call the start of a dollar debt doom loop. Mm-hmm. So the moment there is a strong depreciation, it becomes more difficult for them to service their debt. The moment debt service becomes more difficult, there can be a rating downgrade or markets start doubting them. That means that refinancing becomes either more expensive or simply impossible. So you end up in this negative self-fulfilling prophecy cycle. This is the pro-cyclicality of hard currency borrowing. So whenever there's an external shock, and it can be COVID and it can be a war, these dynamics kick in. Right. And I think more and more governments have realized that over the long term, it's just something impossible to maintain. You cannot have debt sustainability if you do not have debt predictability. And even today, I believe in low-income countries, their external debt is 70 to 85% in hard currency. Mm-hmm. So they don't even know what their debt service is going to be next week, let alone next year. And we're asking these countries to manage a stable economy, whereas as a development finance industry, we're feeding them the most difficult to manage instability and volatility. So from that perspective, I hope more and more debt management offices, but we've seen the same also in the financial sector, have realized, so yes, maybe my nominal interest rate is higher in local currency, but ultimately it allows me to predict my debt service and to be in control of my finances.
I would also add there are a number of other considerations on top of these exogenous shocks which we have experienced, right? TCX has been very actively engaged in the climate finance debate for more than 10 years already. And because I remember that already in 2013 or 14, people were discussing, how the management or the lack of management of currency risk reduces the ability to do climate mitigation projects, climate adaptation projects. That combination from increased risk awareness, increased debt vulnerabilities, but at the same time having pressure to deliver yet more debt to low-income countries to do climate finance, climate mitigation, climate adaptation. This combination has really focused the minds of policymakers and responsibility that we cannot do business as usual. We need to have a step change. We need to deliver responsible financing instruments. And I think that explains this increased demand for instruments like TCX.
How does TCX and its products or things or fit into kind of the discussions around sovereign debt restructuring? I understand that this is a product and ways of lowering the risk, hopefully making debt management a little bit, as you say, kind of more predictable if you're kind of removing this big uncertainty around kind of the exchange rate with the dollar. But still, countries are going to get into trouble at some point. Some things happen. Whether it's under their control or not. We end up having to sit down with creditors from time to time. How do these products fit into that, or not, or is it kind of separate because it's kind of in a different part of the system?
Of course, when the house is on fire, it's too late to buy fire insurance, right? So when you are in a debt restructuring situations, you need to get out of it, and it's pretty complicated. But I think I've been involved in the HIPIC initiative in the late 90s. And I remember that at that time, a lot of emphasis was put on reducing poverty. And there were these programs always. And we used these debt restructuring moments also to make progress in other areas. And I could see, for example, now, if you have debt restructuring operations, that you focus on building additional risk management capacities at the debt management office, in going hand in hand with debt restructurings, right? And focus in particular on that the new debt exposure has less currency exposure, right? That you manage that better. And I think a lot of learning still needs to happen there, both on the lender and on the borrower side. But, we have all the instruments in place, and we can actively use these local currency exchange rate indexed loans to refinance. And I think that is very important to reduce the future currency exposure of the low income countries.
So the idea of let's not waste the opportunity of a good crisis kind of idea.
Exactly. Right? So let's tap into the reform potential, and let's do the things we should have done before the crisis, at least after the crisis.
Right. So just right before, joining you on this recording, I was dealing with some other meetings that were talking about the global sovereign debt roundtable, the big picture reform ideas of, still grappling with the difficulties of putting the common framework into place, G20 conversations, and you already touched upon climate discussions around debt swaps and all of these other things. So I guess what you're saying is, why don't we put this into the mix as well? And I think what you're experiencing, again, kind of going back to my messy question of, why the last 2 years, have you seen an increase of interest in this? Is this idea that the global community is putting everything on the table right now and saying, okay, let's try to do this differently or better, or
there's an economic but also moral obligation to do it better, right? I mean, right. The Asia crisis, the peso crisis, the Latin crisis, they were all FX risk related. And we're just kind of stumbling from crisis to crisis. And we're saying, okay, let's try to innovate and build this risk management capacity where it is needed most, and that is at the borrower side. And let's do it different this time. And let's do it better. There's a lot building better talk, but changing the base of sovereign lending would make a huge difference.
And that's actually what the Larry Summers report, the Triple Agenda report said, right? Which was published in Marrakesh at the annual meetings of the IMF and the World Bank. Mm-hmm. And there one of many recommendations is that, MDBs should be more actively engaged, helping their borrowers to achieve resiliency. And one way is that they are a conduit of taking risks away, currency risks, but also other risks, climate risks, away from the borrowers and shifting them into the international markets. And I think TCX and a scaled up TCX in particular is a good way to achieve that. I had to laugh a little bit when you said, okay, we are using pilot. We have been doing this now for 16 years. We have a lot of data proving that our own resilience and that it works. So yes, let's scale this up now. We have proven it for 16 years and certainly this is I believe, a cost-effective solution.
No, that's fantastic. So that leads me into my second to last question, which is, what do you need for those policymakers that might be tuning in, or people who are listening to this that might have more influence than any of us? What do you need from them? Is it you're wanting to grow more capital, or are you wanting to or is it the DMOs, you're wanting just to do more deals? What are your hopes and dreams for 2024?
First of all, willingness to improve, to change, and to innovate. Mm-hmm. And that is actually to seriously look at index local currency as an alternative. So it's pretty much about developing responsible lending practices at NDB level. Then, indeed, like we said, there has to be over time an increase in TCX's capacity to deliver on that. Thirdly, there has to be policy reforms, and that's mainly at the IMF side, because their DSA, one of your podcasts, of course, was very much focused on the DSA, does not take into consideration that the fact that that the borrower can hedge away the FX risk. So we are in discussions there also with IMF to adjust the DSA for that. Yeah, I think these are effectively the key ones, and together with the fact that MDB should start offering at least the alternative in local currency. And I think the super positive side effect is that borrowers will see, on the one hand, the dollar rate, but at the same time, the local currency rate. And the positive thing of that is what I want to explain. If they are having good and sound macro policies and strong institutions, they will actually, for the first time, see that they are being rewarded for making difficult choices, because they will see that the local currency borrowing rate will go down. Whereas today, all of the MDB lending, whether a country makes a mess of it or not, it's 30 years, 10-year grace, 0.5%. And I think that one size fits all thinking does not help emerging markets to make the right choices.
Probably many of your listeners are aware of the proposals from the Bridgetown Initiative, and Mia Motley was, played a huge role in increasing the global awareness of currency risk and the importance of its management in the context of climate finance. And there was a very interesting proposal in scaling up hedging capacities, right? And one of the challenges in this was identified, affordability, that we need to bring down, make hedging and index local currency, these lending instruments, more affordable for many countries in order to achieve a full takeout. So I think TCX has been experimenting with particularly with the European Commission and to create a concessional hedging platform, and we will work to make sure that this works quite well to deliver affordable hedging solutions and affordable local currency financing solutions, particularly to the poorest countries. And we can combine these solutions with concessional lending practices which exist already, with the GCF, with IFAD, with IDA in particular, or with the African Development Fund, to really then deliver sustainable and responsible financial instruments to the poorest countries in the world.
Brilliant. Last question. This is an opportunity to give you the last word. It's a bit of a tradition now. What do you want to say to the debt managers listening to this? What is the last parting word that you'd like to leave them with?
My last advice would be, if you're sitting down and you're negotiating debt, always ask for the local currency equivalent. And even if it's only to know how outside parties look at the risk of a certain country, or if it's only to enable yourself to make the decision. So do I go for the lower interest rate and speculate that things will be okay? Or am I willing to pay a somewhat higher interest rate and be able to predict my debt service for the next 10, 20, 30 years? So the advice is always ask for a local currency equivalent of the dollar loan you're negotiating.
Brilliant. Well, I think that's right. I think that makes a lot of sense to kind of name the risk right up front and keep that, so that it's not, as you say, just kind of reflexively just taking that dollar and not thinking about it. I think that's
because many people don't know that they can approach IDA, they can approach these concessional lenders and ask to have a local currency equivalent. It's still dollars dispersed, and they still get the dollars, and they will still have to repay dollars, but they will have to pay fewer dollars back if something bad happens to the exchange rate. I think that's very important. And I just would like to make your listeners aware that yes, there are capacity building programs available for deepening the understanding of how to manage currency risk, how to quantify it, because it all starts with quantification, building it into the debt strategies. And then, if you want to know more, please contact us, and we're very happy to work with you.
Fantastic. Well, thank you both so much for your time, and I'm really grateful for this conversation. Thank you so much.
Well, thank you, Jill.
Thank you, Jill. Much appreciated.
Thanks for listening. If you enjoyed the episode, leave us a review and subscribe to the show wherever you get your podcasts.